John, I'm going to throw up a one-year chart of the JNK, which is probably the leading high-yield bond ETF owned and traded by many of our viewers around the world. It hasn't had the collapse that it had right when COVID hit, but it's in that direction. I mean, the bond ETFs have lost a ton of money. I'm not going to say it's scary what's going on, but it's certainly fascinating. What in your mind is actually occurring here?
Well, obviously, people are thinking overall, as you know, interest rates and bonds move in opposite directions. So when interest rates are going up, bonds are going down. Doesn't matter if it's the JNK or the HYG, you know, the high yield, or basically the USHY. Any of those ETFs will be and should be moving down as the interest rates move up. But what we thought was kind of interesting, Brian, is since last week, since the 14th, they've made a little bit of a turnaround. Now, some people might call it a hinge. If you're looking at a chart and all of a sudden you see it pop back up like that, you might say, oh, that's a hinge, and it hasn't proved anything yet, which is true. But bonds are making a pretty significant move, both the 10-year bond and these ETFs we're talking about, pretty significant move. But since last week, that hinge is still holding. People are still betting that maybe when we got to nearly 240 in the 10-year, maybe we got there a little too quickly, and maybe we're going to see a little easing in the short term anyway, Brian.
Well, it's been trillions of dollars, trillions with a T globally, not just here, but globally, that has come out of the bond market. Much of it, John, does not look like it has gone directly into the stock market yet, so I can only assume that people are starting to hoard cash. Oil prices at 115. Oil in the equity markets look certainly to be tied to the hip. Do you have a macro view on the equity market, John? There's just so much uncertainty out there right now.
Sure. And one thing that I'm not uncertain about, and I suspect you as well, many of the viewers, is that if we mercifully got an end to the conflict war over in Ukraine, we won't see those sanctions come off anytime soon, Brian. And that's affecting, again, we've talked about this repeatedly, but whether it's the nutrients, you know, for fertilizers, whether it's foods themselves, because that's the breadbasket of Europe, really, Ukraine and Russia are, or whether it's energy. The amount of energy demand, and then that Black Sea terminal that just got hit by some bad weather and caused another 1 million barrels a day to not come on the market, all of that isn't just like throwing a light switch, turning back around. So I'm a little concerned that those will be a drag for quite a while.
Yeah, and they're saying that terminal, by the way, could be out for 6 weeks, although Kevin Book earlier said, John, that the weather thing may simply be a Putin ploy. It doesn't matter. Oil's at 115. On a macro level, market rebellion, looking at options bets, are people getting more bearish on the options side, or are they getting bullish?
No, they're actually wondering if this 200-day that we retook the other day, if this 200-day moving average holds, Brian, for more than 24 hours. People are not necessarily getting bulled up, but they're certainly lightening up on those put trades pretty significantly across the board. IWM, QQQ, Spider, all of those. That doesn't mean they're just jettisoning them, but it does mean that they're lightening up if we hold the 200-day.